market movers. This is The Pulse.
Good morning and welcome to The Pulse. I'm Tom McKenzie in London. These are your top stories. Nasdaq futures pointing lower after the AI rally returned to Asia. SK Hynix makes its debut today, confirmed as the biggest ever US listing by a foreign company. EasyJet shares jump after the budget carrier receives a surprise offer from Apollo that sets up a potential bidding war with Castlelake. The yen gains after the Japanese finance minister calls on pension funds to invest more in domestic assets. Meanwhile, Goldman says carry trades face the best conditions in more than 2 decades. Plus, don't miss our exclusive interview this hour with the Spanish economy minister, Carlos Cuerpo, as Spain calls for Europe to pull more of its debt. Let's get to the markets then. We said in the headlines, pointed out that Nasdaq futures then, after the gains of yesterday, currently pointing lower by around 5/10 of a percent. We're getting a redhead across the terminal as we consider what is happening cross-asset across these markets. UAE oil output hitting a record of 4.1 million barrels per day in June. Barrels per day, 4.1 million barrels per day. Let's check in on the oil price then. You're currently looking at Brent at $75 a barrel, down 1%. WTI at 71.34. The Japanese yen in focus. Strength today then on the back of those comments from the Japanese finance minister. We'll unpack that story for you throughout this hour. Currently up 0.4% versus the US dollar. And it's the weakness in Brent that is giving some relief across the fixed income markets as well, at least for today. Let's take a look at the European markets map. Across the benchmark, the stock 600 is currently essentially, well, it was flat. Now it's up about 0.1%. You're seeing the gains coming through for the FTSE 100, up 0.2%. Pretty modest, just adding 22 points. Stronger gains over in Italy. The FTSE MIB is up 0.5%, and 0.4% is the gain coming through on the IBEX over in Spain. The DAX in Germany at 25,145, just adding 20 points so far in the session. So modest upside coming through for European equities broadly across the board. Now, US futures pointing low then after another volatile week, of course, despite sentiment getting a boost from SK Hynix, raising $26.5 billion in its ADR offering. Shares start trading today. Let's bring in Bloomberg senior strategist Neil Campling for the details. Neil, there is strong investor appetite, it seems, then, for SK Hynix. What does it tell us about the broader sentiment in this space? How much and what kind of indicator is this listing giving us?
I think one of the indicators we had into the deal, Tom, is we've seen the likes of some of the Mag 7 stocks, in particular NVIDIA, as being a funding trade and positioning trade to allow some of the investors to prepare assets into this listing. There's clearly huge appetite for the memory trade. The memory stocks themselves, Hynix and Micron, trade at very low valuation multiples relative to the market. There's reasons for that around cyclicality. But in terms of giving access to the liquidity here, from discussions with clients, we actually felt there was more institutional interest potentially in this trade than there was actually in the SpaceX IPO, because this is an established AI business in terms of the HBM4 memory chips that go into AI, as opposed to SpaceX that is at the early stage of building out its own AI platform. So it's of huge interest. One thing, though, to be aware of is that investors are cautious on, I think, in the medium term, is around volatility. These stocks are very volatile relative to the market, and that's likely to continue when you think that, as Bloomberg reported overnight, there are a lot of leveraged ETF funds that are going to be partaking in this memory listing to have Hynix on the list. So, and potentially, there could be a way of Hynix moving into the benchmark chip index, the SOX index, in due course this year as well.
Yeah, that's interesting, isn't it, in terms of what's happening with the leveraged ETFs, and we've seen, to your point, the role that they played in the volatility, arguably, at least when it comes to the Kospi. Neil, what is your sense? Are we getting any signals that this opens the door for other Asian companies looking to list in the US?
We've been down this route before, Tom, but I think what we need to be a little bit cautious here, because this particular listing tapped into the AI trade, it tapped into memory, it tapped into momentum, and it tapped into parts of the market that there's huge appetite for. If you look at other Asian companies, there's less obvious routes to US listings, especially when a lot of the kind of tech positions that are there are around sort of some of the Chinese blacklisted companies and stuff. So I wouldn't necessarily mean it opens the floodgates for listings, but if there are some unique opportunities that play into the same types of the part of the market that there's appetite for, then it might well do. It's something to keep an eye on, but I wouldn't expect a deluge of offerings to come to market, to be honest.
Okay, maybe not a deluge, but something to monitor. Neil, thank you for the context, the details as ever. Bloomberg's Neil Campling. Meanwhile, Bloomberg's Ed Ludlow will be speaking with the SK Group chair. Catch that interview at 3:30 p.m. London time today. That is one certainly to mark on your calendars. Make sure you tune in for that conversation. Now, to talk about some of the concerns around AI CapEx spending, let's bring in Marina Zavolock, Chief European Equity Strategist at Morgan Stanley. Marina, good morning. Always lovely to see you. Thanks for coming in this Friday. How are you thinking about the AI trade right now and Europe's place in that story?
Yeah, I mean, I think this is a healthy pause. We were seeing parabolic rises in some of these AI CapEx share prices, especially in the US, but also in Europe. If that continued, we'd be reaching the end of the cycle pretty soon here. So I think this debate on, whether we're at the end of the cycle is a healthy debate. It tends to happen as we go up into the end of the cycle. I don't think we're there yet. When you look at indicators like M&A, even if you look at IPO volumes, we're not at peak cycle levels. We're going to get there, at some point, but we're not there yet. Is that a this year story? Is it more of a 2027 story? Timelines I know are difficult to pin down. But M&A, like we published this in our note today. Yeah. If you look at global M&A volumes and you draw a line across the peaks, we're like 2/3 of the way to a peak. I'd be more worried if we were at that peak, then we'd be evaluating this a lot closer. Earnings trends are really positive. A lot of the AI kind of spenders on AI are actually upping their CapEx guidance at the moment. So I'm generally not concerned, and I think it's healthy that we have a pause and we have this kind of choppy sideways trading. But in Europe, going back to your question, I mean, the perception is we don't have AI. We do. We estimate about 14% of the weight of the MSCI Europe index is direct AI CapEx beneficiaries. And those are companies that play into the data center and infrastructure story. Exactly. Yeah. Okay. And they tend to have exposure outside of Europe. So to the buildup in the US and Asia. Is that underappreciated still? Is there a valuation gap? Is there still an opportunity for investors to get exposure to those names? I mean, the valuations on most of those names are high. And we have this kind of scarcity premium in Europe among those names. But I think from an earnings point of view, some of those names like European semis, the earnings trends are just starting to take off more strongly, more sharply compared to the US. So you're going to have that a bigger earnings kicker, I think, in Europe. Okay, so there's a catch up. Yeah, on the earnings front. And investors maybe can get exposed. Yeah. Plus we have less levered ETF exposure, so the volatility is not as high. Positioning is not as high. Which ties into, of course, what Neil was talking about when it comes to SK Hynix and the story over in Korea in particular. You talk about a barbell approach. Yes. Explain that. What is the rationale for that? What's the conviction in that barbell approach? Yeah. So with this pause in the AI CapEx trade that we've seen recently and the volatility and the levered ETF exposure, what I've been noticing is investors are coming to me, non-dedicated investors, for the first time in a while since earlier this year. And they're saying, I love the AI CapEx trade. I have a lot of that in my portfolio already, but I'm concerned about this volatility. It's impacting, my risk-adjusted returns, and I need to diversify. And I see Europe as possibly a good diversifier. And so we are recommending an approach of you hold on to the AI CapEx plays, but you also diversify. You go back to, you stop ignoring the kind of multi-year compounders, the areas where fundamentals are improving. So you have a bit of both. And having those non-AI compounders allows you to reduce the volatility in your portfolio. And we're seeing demand for both sides of that trade. And we've been recommending broadening, and you're seeing, like we just published our earnings preview for Europe today. We're really constructive. earnings strength in Europe is led by the AI complex, but you have broadening elsewhere as well. So you have quite a lot of strength outside of the AI complex as well.
You're really constructive on European equities.
Yes.
Part of that is being led by the AI stories you just said,
yeah.
But there's a broadening.
There's a broadening.
Does that broadening continue if the energy and inflation shock comes back? This time last week, it was all about lower oil prices, lower yields, maybe an expectation central banks can be on hold. That has been put into question again as a result of the geopolitics and Iran and the Strait of Hormuz.
Yeah.
What is your level of conviction that we can broaden out and diversify, that we can broaden out the trade in Europe if oil prices come back up, if inflation becomes a challenge again?
Yeah, so, I mean, part of our constructive view on Europe is inflation. So I think in contrast to popular perception, inflation is good for European equities in particular. We have a lot of real asset exposure. We have banks exposure. Banks benefit from inflation.
You're overweight banks?
Yeah, we're overweight. That's our primary, I mean, our number one diversifier recommendation is banks, but then we have more broad exposure. We have that AI CapEx exposure, also inflationary. So if you add up the areas of the European earnings pie that benefit from inflation, 60% of the European earnings pie. So I think people don't realize how much we benefit from inflation. Consensus earnings growth for Europe this year now are 17%. The last time we were anywhere near this was 2022. The last time we had inflation and kind of moderate low growth. So inflation is great for European equities, just given the exposure of the index. And then people were getting really excited, and I saw some of our competitors were saying, you know, oil's going to go down to 60. Or clients were saying maybe we go down to 50. I think actually if we stay 70 to 80, that's actually a very, very healthy range for European equities, given our exposure. We need a little bit of inflation to keep earnings healthy, and margins have just broken out to all-time highs in Europe as well.
Okay, 70 to 80 could be the sweet spot for European
equities. Is the sweet spot, yeah.
Overweight banks and with a barbell approach. Marina, really fascinating insights on these markets and how to position. Marina Zavolock, Chief European Equity Strategist at Morgan Stanley.
Thank you.
Now, EasyJet shares soaring this morning after the airline received a fresh offer from private equity firm Apollo. Let's get more and bring in Bloomberg's managing editor for space and aviation, Benedict Carmel. Benny, a surprise twist then in this takeover saga. Did you see this coming? Did we see this coming? What happens next? How real is this offer from Apollo?
No, I absolutely did not see that coming. I was just settling into my desk this morning when the offer came, so a surprise. We thought that over the weekend EasyJet and Castlelake had reached an agreement. To remind everyone, Castlelake has sort of been the original suitor. They had, for the past month, sought to take over EasyJet and made a number of offers, and the last one over the weekend seemed to get them over the line. And then suddenly, out of nowhere, literally, Apollo comes in this morning and says, we are offering more. It's also interesting that they are sort of striking a very different tone. They're quite sort of consensual and say that they are sort of on EasyJet's side. They want to keep management intact. They want to keep the brand intact. That obviously speaks to some of the concern on the EasyJet side that the company would be broken up under Castlelake. So Apollo trying to sort of be a sort of the friendly owner, shall we say, and obviously offering a higher price. £7.15 is what they're offering, and that compares to $6.90 on Castlelake.
Benny, thank you very much indeed for that update on that Apollo bid, and we'll see, of course, how that story transpires. That friendly offer then coming through from Benny, and clearly the stock price, EasyJet, benefiting on the back of that story. Our aviation lead, Benny Carmel, joining us with the details. Coming up, how US-Iran tensions and the AI trade are playing out in emerging markets. We're going to discuss with Felix Kalen, Global Head of EM Research at SocGen, Corporate and Investment Banking. Stay with us for that conversation. This is Bloomberg. Japanese bonds rallying this morning. The yen also rebounding from multi-year lows after the finance minister called for Japanese pension funds to invest more in domestic assets. Let's get more from Bloomberg senior editor Brian Fowler in Tokyo. Brian, some pretty significant, sizable moves, particularly when it comes to JGBs, and we're seeing that with yields down pretty sharply on the back of these comments. What is the thinking then behind this call from the finance minister? Was this a non-scripted and unscripted moment, or is this a thought-out plan from the Ministry of Finance to get those domestic flows going?
Yeah, Tom, I think the context is important. So she made these comments at a regular post-cabinet meeting press conference. She'd talked about various other things as well, BOJ independence among them. And so it's not like she said, stopped everybody and said, hey, I want to announce this initiative. She was asked a question about the growth strategy plan that was announced last week. That's the one where they're going to spend a couple $1 trillion investing in 17 key industries over the next 14 years. And the question was, well, what does that do for ordinary citizens? And Katayama's response was, well, I would like to encourage pension funds and individuals to put more investment in domestic assets. The thought being, presumably, that if the capex boosts the values of these companies, then that would boost the stock valuations as well. So it's not really clear, how far she's thought this through. It came across a little bit as an off-the-cuff remark. On the other hand, it also comes against the backdrop of consistent inflation now in Japan. First time we've seen that in a while at 2%. And the benchmark rate at 1% at the BOJ. So there is definitely a sense on the government side that individuals really need to be invested more in financial assets if they want to keep up with inflation.
Brian Fowler, thank you very much indeed with an update out of Tokyo and what we've been hearing from the Japanese finance minister, of course, Bloomberg senior editor Brian Fowler in the Japanese capital. Let's check in on Japanese assets then before we bring in our next guest. As I mentioned, yields down sharply, bonds are bid, JGBs are bid. You're looking at the 10-year yields down 13 basis points, yielding 274. And the Japanese currency, as you can see, 161.70, so up 0.4% versus the US dollar. But will this be sustained? How real is this, given that the yen has been at near 4-decade lows? Let's bring in Phoenix Kalen, Global Head of EM Research at SocGen Corporate and Investment Banking. Phoenix, good morning. What do you make of what we've been hearing from the Japanese finance minister? Sustained relief in terms of the pressure we've seen on the yen, or is this going to be short-lived?
I think it makes sense for them to want to try to encourage for domestic investors to invest more in local assets, because that's going to help equity prices and also bring down bond yields, which is going to alleviate some pressures on the fiscal side. So it's important to try to do that. Ultimately, I think the growth equation out of Japan is still really lackluster compared to other DMs like the US. And I think in terms of those underlying fundamentals, it's still not great to have a context where you can have sustained appreciation. So I think we're likely to see still interventions in the Japanese yen to try to get it to strengthen. And we can see that over the course of many decades, if you have periods of very sustained, strong appreciation that goes well beyond kind of the fair value models, that can actually cause the seeds of there to be huge unwinds that can last many, many years. And then we get huge periods like right now of sustained depreciation. And you don't want for that to go too far, because the farther it goes, the more painful it is on the way back, as you've had these multi-decade cycles through the yen. So I think for us, we're expecting for more interventions, but we don't think ultimately at this point, because of the growth dynamics, that is going to be very effective.
Okay, so more interventions, they won't be effective. So then the spotlight shifts back to the BOJ. I mean, is this a BOJ that's behind the curve? Do you expect them to hike more aggressively than maybe the markets are expecting? What is the cadence for the BOJ then?
Yeah, I think they have to kind of approach that quite cautiously. Right?
Yeah.
They want to defend kind of the growth that they're nurturing in the market, and at the same time kind of fight against the inflation pressures. But they are going to be quite cautious, we think.
Okay. From the yen to the Korean won, there's SK Hynix listing, some reporting suggesting there's going to be flows back into Korea. Maybe that's going to be supporting the Korean currency, which has been also at decade lows and been under significant pressure, despite, of course, this historic rally that we've seen for the Kospi. Part of that is portfolio rebalancing. What is the trajectory for the won? Does the ADR of SK Hynix To what extent is that supportive for the Korean currency?
Yeah, I think that has been quite supportive this week in
terms of
those,
yes,
in terms of those flows. Yes, and in terms of the investments that come on the back of that. But overall, what we've seen is that the dynamics around the Korean won has really shifted from something that's more trade related to now something that's much more portfolio flows related. So whenever we have the huge kind of upswings in Korean equities, as we've had over the course of the past 12 months, then you have these huge rebalancing flows from foreign investors to take money out and try to rejigger between the Asian markets. And so that causes outflows and weakens the won. And at the same time, on the other side, if you have periods of risk off, that also causes outflows and weakness in the Korean won. So it's impacted by all of these kind of external dynamics one way, which is weaker.
Does it? Korea is energy dependent, so there's a challenge there, of course, when it's buying so much energy, and the Korean won at the levels that it's currently at. It's a boost for manufacturing, but a challenge in terms of the inflation story and the energy cost story. Is there a policy response on the back of this? Do we expect intervention from the Korean finance ministry?
Yes, we have actually seen intervention this week.
Yeah.
We are expecting for them to continue interventions. We're expecting for them to continue rate hikes as well. So rate hike at the next meeting, July 16. And that will help to curb a little bit of the pressure. But overall, it's still one in which we're likely to see short-term more weakness in Korean won.
What else are you seeing? What are your favourite trades, favourite FX crosses now in the space, in the EM space on which you focus?
Yeah, so our favourite trades are very much in LATAM, especially. So we still like the terms of trade kind of buy the winners theme. So we're still expressing that via a number of long BRL positions. So long Brazil versus Euro, long Brazil versus Chile, long Colombia versus
And that's
Chile.
A balance of trade story.
Yes.
That's a commodity story.
Yes.
And what
it's
assumption?
A carry story.
It's a carry.
Huge,
it's a carry
huge
story.
Carry story.
Okay.
Yep.
And the window is open for that carry story.
Still, very
for the
much
BRL,
so.
still.
Yes. BCB is still relatively hawkish.
Yeah.
Market is actually pricing in more hikes for the BCB later this year. And so, yes, that carry story is still going to be there and still is quite substantial. And on the political dynamics, of course, Brazilian elections in a few months, that is causing some consternation about headline risk, fiscal loosening. We think that because the market has actually largely priced in a Lula win, then that removes some of the risk around further currency depreciation because this is what is already anticipated.
What assumptions are you making about the greenback, about the dollar then, as you look at the EM space?
So we're expecting for the dollar to slightly appreciate, but that depreciation we think is going to be more against the DM currencies than against the EM currencies. So we think in LATAM, a number of those currencies are likely to appreciate against the dollar. So MEX, BRL, COPI. We think that some of the Asian currencies might depreciate against the dollar. So most of the bloc outside of China will probably depreciate.
Okay, is it a balance of trade story when it comes to Central and Eastern Europe? What are you looking at when it comes to CEE in that space?
So in that space, it's more about kind of the tension between how much the central banks are now having the scope to continue some easing. As oil prices are kind of medium term much lower in expectations, and so there have been some indications like from Poland this week, right? They were much more dovish than expected, and that hurt the currency. But overall, we think that the currencies are broadly going to be quite stable there in that space, and so there would be some opportunities to still get back into some strong narratives, like Hungary, for instance.
If we were to get another oil price shock, if there is another step up in aggression and violence in the Middle East, to what extent would you have to rethink some of these calls in FX, or is that kind of factored in?
So a lot of the trades around kind of the terms of trade, those are already positioned for any kind of re-escalation. So the Brazil-Colombia type trades are still going to do really well, actually, going to be magnified in their performance if we have a re-escalation. We've got some bullish trades on like long Turkey, and so that might be under pressure.
Phoenix, thank you very much indeed for bringing your views to us this Friday morning. Phoenix Kalen, Global Head of Emerging Markets Research at SocGen Corporate and Investment Banking. Coming up, we're going to bring you an exclusive interview with the Spanish Economy Minister, Carlos Cuerpo, as Spain calls for Europe to pull more of its debt. What will the Germans say? That is next. This is Bloomberg. morning. Welcome to The Pulse. I'm Tom Mackenzie in London. These are your top stories. Nasdaq futures pointing lower after the AI rally returned to Asia. SK Hynix makes its debut today, confirmed as the biggest ever US listing by a foreign company. EasyJet shares jump after the budget carrier receives a surprise offer from Apollo that sets up a potential bidding war with Castlelake. The yen gaining after the Japanese finance minister calls on pension funds to invest more in domestic assets. Meanwhile, Goldman Sachs says carry trades face the best conditions in more than 2 decades. To the auto sector now. Volkswagen has announced it plans to cut its model lineup by as much as 50%. 50%. The move is part of a savings plan announced after a supervisory board meeting that stopped short of agreeing on deeper workforce reductions. We're joined by Bloomberg's Autos reporter Stefan Nicola, who is across all the details of this. Stefan, talk us through what was agreed then by the board last night.
Yeah, this was a key board meeting for Oliver Blume, the Volkswagen CEO. He wants to make Volkswagen smaller, faster, more profitable, and he presented sweeping restructuring push in yesterday's meeting. The board didn't agree on a lot of things. It pushed back on some aspects of it. Labor has pushed back against job cuts and plant closings. But what transpired from the meeting is that VW wants to halve its model lineup. So that means cutting derivatives of individual models, reducing overlap between the different brands, and just become more efficient to focus on the most profitable segments.
The challenges are acute, Stefan, obviously, as you know all too well, not just for VW, but for the broader auto sector in Europe. There's the price pressure, of course, there's the competition from China, there's the wrangling then amongst the board, the unions, and you kind of nodded to that with the focus on labour. What are the chances at this point of further cuts, or are we done?
I don't think we're done yet. The halving of the model portfolio, I think, is the first step. Blume will go into further negotiations with the board, with the labor side. That's broadly expected. So for sure, we'll have more capacity cuts. We'll have job reductions. Also, we would expect those. The devil is in the detail, in the fine print, and that's going to have to be ironed out over the coming month for Volkswagen. This is a slow-moving tanker. You have to get almost everybody on board for these sweeping decisions. So the CEO has a lot of work cut out for him, and yeah, it's going to be tough in the coming months.
Yeah, a slow-moving tanker. That is the part of the problem, isn't it? In an environment of rapid innovation and increased competition. Bloomberg Stefan Nicola with the details on a deeply significant story, of course, for the European auto space. Thank you. Meanwhile, zooming out to the macro picture in Europe, Bloomberg understands that Spain's push to boost joint EU debt issuance has been met with scepticism from some of the bloc's top economies. Sources say, surprise, surprise, Germany and France were among those who questioned the proposal at yesterday's Eurogroup meeting. Let's go to Brussels, from where our chief Europe correspondent, Oliver Crook, has an exclusive interview. Ollie.
Yeah, that's right, Tom. We have a lot to unpack here with the Spanish Economy Minister, Carlos Cuerpo, including his sort of pitch to joint debt. He's here in Brussels, of course, for that Eurogroup meeting, but a lot of other things to talk about, including the sort of trade discussions we've been hearing over the last couple of days at the NATO meeting, Spain really playing a starring role there in the mind of the President of the United States. So I'd like to start there, Mr. Cuerpo, if we could, about basically what has the communication been from the United States. He arrived in Ankara, the President of the United States. He says he's going to cut off all trade with Spain, going to cut off effectively relations to a certain extent with Spain. By the end of the meeting, we were somewhere completely different. What are the conversations that have been transpiring over the last 3 days?
Well, you know, the main message I think that has transpired is that Spain is making good on its commitments towards defense spending. Actually, President Sanchez was very clear at this stock-taking meeting of NATO that Spain is the 7th largest defense spender amongst the 32 NATO members. So that actually positions us, as we've always said, amongst towards those countries that are fulfilling their commitments, that are covering for the capabilities that we did commit to, and therefore being a reliable partner. And I think that's the main message, again, that transpires from the data that is actually speaking for itself.
And the president made some allusion, though, that Spain would say that they made and they will honor requests for lots of payments, and that if they didn't, we wouldn't even talk to them. Did anything change in Spanish policy, from Monday to Thursday? Well, again,
last year we increased our defense spending by more than 10 billion. Again, making good on all the commitments and being a reliable partner. That's a message that we've been trying to convey all along, and that I think now is finally getting there, as we see that we made good on that pitch by actually proving it with the numbers. So that's good news.
But the 5% commitment is still off the table for Spain.
Nothing has changed on that front. As we said already, we will cover for the capabilities that are assigned within NATO. You know how this goes. We have an update of the threats that all members will be facing, and then you assign capabilities to cover for those threats, and our share will be covered by Spain for sure.
But then I want to talk more broadly about the sort of approach of the President of the United States now, threatening the tariffs against Spain. He's done similar things to France about just sort of digital taxes. I'm sure you're thinking about a lot of different scenarios about if these things were to materialize. If there were an effectuation of a tariff threat on Spain, if he were to impose it, would that automatically kill the Turnberry deal?
Well, let's go back somehow to the last 18 months, where there's been somehow a lot of discussion on the new tariff context, and where we've been actually negotiating from the EU side, because as you know, it's an EU negotiation that goes on. All member states are dealt with in trade terms by whatever the EU or the Commission agrees upon. So the August agreement is the one that is valid for French companies, for Spanish companies, or for German ones. And what has gone on, despite all the uncertainty, for example, is that investment from American companies in Spain in 2025 grew by around 18%. So somehow the relationship is so strong that it's actually still ongoing. There's a strong inertia around it, and we have to make the best out of that existing relation. Yeah. And that's what we're trying to do also from the Spanish perspective, trying to help our companies navigate this new situation, opening new trade offices in the US. I've been 10 times in the last 18 months to the US, again, trying to really strengthen that relationship.
But I think for those companies, it's important for them to try to understand what the reaction function will be from the European side if we do see unilateral tariffs with a single member state. So I guess the question is, if the United States imposes tariffs on Spain, have you spoken to the Commission? Does that, in their mind, there are a lot of clauses that were added to that trade deal, basically kill the US-EU trade deal?
Well, we don't have, let's not speculate on what can happen. There is no specific executive order or measure against any specific country within the European Union. But the Commission has been very clear also this week on the fact that they would, of course, always protect the interests of the Union and of each and every one of its member states. And again, it's trade is an European policy, European Commission policy, and I think a message to the business community as well. We want to give them predictability, stability going forward. So the reaction function somehow should be that we will make good on the agreement that we signed from the European side. Everything is set so that we can go on with it. We expect also the same from our US peers in the next few weeks. Let's give that positive message to businesses.
And so trade falls under the European remit. You would like to see more debt fall under the European remit. You'd like to see a third of debt issued from the major European economies come from the EU. This obviously debate of joint debt is one that's always been heated here within Europe. You've renewed it. You've come out in the Bloomberg opinion pages to explain it. Give us your pitch.
So somehow it's about efficiency in how we issue debt. So it's reducing fragmentation. This is not about new debt or increasing the overall level of debt in the European Union. What we're proposing, what we're putting on the table is the fact that fragmentation is costing us dearly. So we need a safe asset to back our capital markets union within the European Union. And that safe assets need to be liquid enough, need to actually have a deep market so that we can cover for the demand. There's a strong demand, but there's no supply of jointly issued assets. So it's a very short, small market. And what we're proposing is to increase that market by substituting part of the upcoming national debt, 1/3 of annual redemption, and whatever is allowed by European fiscal rules. So we keep this moral hazard concern in check by saying that we have to comply with fiscal rules in any case. So that would help the joint issuance to reach the 5 trillion threshold, which is what is considered as a genuine benchmark going forward, and that would reduce financing costs. And we estimate, and I will finish with this, that the overall savings would amount to up to 25 billion on a yearly basis. This is taxpayers' money being saved.
But of course, there will need strong political consensus on that. How is that message cutting through, particularly in Germany?
Well, we know that this discussion historically has been a difficult one, but there is a new window of opportunity, and the context is completely different. We're not talking about new debt. We're not talking about a fiscal union or a mutualization of risks. We're talking about efficiency in debt issuance. We're talking about reducing fragmentation costs, as we're doing on other areas. And you know, also, for example, the firms could benefit from us having a safe asset, and therefore lower financing costs being translated also to lower financing costs for businesses. So it's a no-brainer, and we really have to circumscribe that discussion to the current context.
And another sort of difficult conversation is one around China at the European level. You're one of the nations in Europe that is advocating a much stronger relationship with China, yet you acknowledge some of the issues with the trade imbalances. How does Spain suggest that we should deal with those imbalances, and what are the next steps you think at the European level? Well,
we need to be a key player going forward, and that means engaging on a par basis with both the US, China, or other key players. And so engaging means negotiating, having a fully fledged open dialogue with Chinese authorities, both to try to solve these, as you said, trade imbalances, but also to see how we can have a win-win situation in terms of attracting investment towards the EU within our security agenda, but that also produces value added within Europe, that generates technological transfer also to Europe, because we have to admit it, in some sectors there is a technological gap or lag in Europe with respect to China, and so we need to, again, foster these investments that are productive for the European Union and rebalance trade.
And I want to get your perspective also, because another piece of news we got over the last few days was potentially the restart of the war in Iran. Obviously, this will have consequences for the European economy. Inflation is still very high in Spain. What do you anticipate the impact is going to be on the economy? How should the European economy prepare?
Well, somehow, as you said, we had some piece of good news over the past few weeks, although over the past few days, volatility has come back, but prices of oil are still way below what they were around a month ago. What we'll be doing in Spain is putting in place specific measures to protect the industry, to protect sectors like transportation or the agricultural sector as well, and to protect citizens. 5 billion program, fully fledged one, to protect during the first 3 months, and now we extended that program to protect also citizens up until September, although there is a phasing out, understanding that somehow the situation will slowly also be better in the next few months. But in case it's not, we're still ready to come back to the previous level of support.
And one quick final question. We've talked a lot about very important topics. One final important topic. I spoke to your deputy, your counterpart, Deputy Prime Minister of Belgium earlier this week. He predicts a win for Belgium 2-1 tonight with Spain. What is your prediction?
Well, you know, I don't want to jinx it, so I won't say a specific score, but I'm very confident that we can make it, and then Spain has one of the best teams, and we will all be rallying behind our national team.
Well, Carlos Cuerpo, thank you so much for your time there, the Economy Minister of Spain. And if we don't hear from the Prime Minister or the King, I think we'll take that as the official Spanish position on the match tonight.
Okay, we'll take that. That is the essential question, Oliver Crook, ahead of that game between Spain and Belgium later tonight. Belgium, of course, Oliver Crook there with us and with the Spanish Economy Minister. Ollie, excellent conversation as well on the trade story, the dynamics with the US, China, of course, and that joint debt proposal. Ollie, thank you. Other stories that we are following this Friday morning. Andy Burnham's path to becoming the next UK PM looks almost certain after 322 of Labour's 403 MPs nominated him to replace Keir Starmer as party leader. Burnham said he was, quote, deeply grateful for the support, saying it reflected a shared belief that Britain needs a new approach to politics. He said the, quote, circuit breaker he is offering means shifting power out of Westminster and rewiring the economy for ordinary people. Vodafone shares are up after French billionaire Xavier Niel agreed to buy a stake from Emirates Telecommunications Group. Vega, an investment vehicle controlled by Niel's family, will acquire more than 16% of Vodafone's shares for about $112.5 apiece in a $6 billion deal. And former Fed chairman Ben Bernanke has been appointed to Anthropic's Long-Term Benefit Trust. It's a governance body designed to safeguard the startup's public interest mission, advising management on decisions around AI risks and impacts. Bernanke and 3 fellow trustees hold no financial stake in the company, but will have the power to appoint and remove board members. Now, with home ownership out of reach for many young people and AI reducing their job prospects, many are turning to investing in the hope of securing their future. But with index funds seen as too slow an investment, more young investors are putting their money into meme stocks, options and crypto. Bloomberg Originals has been looking at why they are prepared to take on so much risk.
There are many types of risk, and now even trading is an extreme sport.
In this video, I will start with risking only $100 per trade.
Bro, it's simple. If you can scroll TikTok, you can trade.
You have the fear of missing out on a trade.
And judging by social media, everyone is getting rich.
We're at $232,000.
Just today, I made $16,000.
More young people are investing than ever before, and they're learning about markets in a way no generation has.
Gen Z really is distinct from other age groups. If you go on social media now, you will see a lot of sophisticated trading techniques used in ways that I think no one would have imagined a 20-year-old in 1990, 2000, or even 2010 doing or even knowing about.
I want to show you this trade I'm taking.
A lot of that activity has also broadened to sports gambling, for instance, or trading on prediction markets.
But there are worries that these investors are over-leveraged, taking one too many risks.
I've always been a big risk taker. It's kind of just part of who I am.
3, 2, 1, to the moon! Holy Well, you know what?
Gen Z has a highly differentiated view of risk.
They don't drive, they don't date, they don't drink. On the other hand, they're also this extremely risk-taking generation.
And for many, it's the only path they see to getting ahead.
YOLO stands for you only live once. So YOLO bets would refer to risky investments where the trader has an attitude of, you go big or you go home.
Well, subscribers can watch that full documentary right now on the terminal and at Bloomberg.com. Next week, Bloomberg is hosting a webinar on the new wealth playbook, exploring alternatives and the so-called next-gen client. You can scan the QR code right now to register and take part in the audience Q&A from 3 p.m. London time next Tuesday. Coming up inside the secretive Chinese semiconductor maker that is set to shake up the trillion-dollar memory chip market, our big take is next. Some fantastic reporting. This is Bloomberg. AI pioneer Yann Lecun says he believes Europe has missed the boat in the race to develop large language models in AI. Lecun was Meta's chief AI scientist, but left to launch his own company, Ami Labs. He told me at the Race Summit yesterday in Paris why generative models don't work in the real world.
Most of the details in the world, in the physical world, are not predictable. And so the very idea of a generative model does not work in the real world. It's relatively easy to predict the word that follows a sequence of words, which is really what LLMs are doing, whether it's natural language or code or whatever, right? You show the system a long sequence of words, and you train it to predict the next word. It can never exactly predict the word that follows, but it can produce a score for every possible words in your dictionary or a probability distribution, right? So then you pick a word from that probability distribution, That's the word the system is going to produce. You shift that into the input, and now you can produce the second word, shift that into the input, third word. That's called autoregressive prediction. It's a very old idea, and that's what LLMs are based on. If you want LLMs to reason a little bit, you have it produce lots and lots of those sequences, and then you have another neural net that selects the best answer among all of the ones that are produced, which is ridiculously expensive. But this is how those, coding, mathematics kind of system work, more or less. Now, if you want a system to understand the real world, why not use the same technique? Take a piece of video and train the system to predict what's going to happen next in the video. And if you train the system to predict at the pixel level, it simply doesn't work. Because most of the details in video are not predictable. Most of the information contained in video is entirely unpredictable. If I take a video of this room, I point the camera on this side, I slowly rotate the camera, I stop here, and I ask the system, fill in the blanks, tell me what's going to happen next in that video. Probably going to predict the camera is going to continue rotating. There's absolutely no way it can predict what every one of you looks like. There's just no information from which that it can use to make that kind of prediction. So if you train a system to make that prediction at the pixel level, you kill it, because you basically are asking it to solve a task that is completely unsolvable. Now, of course, you're going to say, but wait, we have systems that can do video generation. Yes, they can, but they're going to make a prediction that is false. They're not going to predict what you look like. They're just going to put random people there, right? And those systems don't really construct a good understanding of the underlying physics or reality of that. So the technique we've been working on for a number of years, while I was at FAIR, and since we created AMI Labs, is called JEPA, and it consists in training a system not to generate and predict all the details of a signal, but to construct or learn an abstract representation of that signal, of a video, and then to make predictions in that abstract representation space.
Yann Lecun, Executive Chairman of AMI Labs. Now, as China ramps up its focus on tech self-reliance, there's more attention on its homegrown chip makers. One such company is CXMT. It's launching China's biggest IPO this year as it seeks to double output. The Secretive company is the focus of today's Bloomberg Big Take. For more, we are joined by technology reporter Gao Yuan, who has all the details and will be covering this for us. Gao, what do we know about CXMT? It's secretive, as you say. What have you discovered about this company? And is it really a challenge to Samsung and SK Hynix in the memory space?
Good to see you, Tom. Yes, well, CXMT is emerging from a nobody to arguably the most important chip maker in China, all because of this memory chip shortage. So the Chinese AI companies need memory chips, the phone makers need memory chips, and they have to rely on Samsung, SK Hynix, and the Micron for those kind of products. Now with the CXMT, they can source from a local supplier, which is great news for them. What we found was that apart from CXMT, it has 3 companies helping them with chip design, chip manufacturing, packaging and testing, so that they can fast, forward with their plan to expand the capacity, which is very critical for not just for them, but also for China's AI effort.
Is it feasible that Apple uses these chips at some point?
Potentially, yes, but it's a long way to go. Again, they have to expand their capacity first, especially for AI. They need to start to make HBMs for Apple. It will need lots of DRAMs, which CXMT is doing. But in the future, if they want to supply it to a bigger client, they will need a lot more capacity. That's the bottleneck for them right now.
Okay, so capacity is the bottleneck. They're building out the supply chain in China, and they could end up being a significant player in the memory space. The IPO coming up, of course. Gao Yuan with the deep dive, and the Bloomberg Big Take is really worthy of your time today. Bloomberg technology reporter Gao Yuan with that fantastic reporting. So look at that on Bloomberg.com and on the terminal, of course. US futures then, talking of tech, NASDAQ 100 futures pointing lower right now by 0.5% after the gains of yesterday. Here in Europe, the Stoxx 600 is currently down 0.1%. Up next, it is Bloomberg Brief. Stay with us. This is Bloomberg.